It's Monday, November 18th. From The Economist in London, this is Money Talks, a weekly conversation around the themes of business, finance, and economics. I'm Stanley Pignal, the finance correspondent.
And I'm Ryan Avent, the economics correspondent.
This week, we look at global trade, we will discuss frothiness in markets, and finally look at recruitment in financial firms. Ryan, 160 trade ministers at the start of next month will meet in Bali to talk about global trade. What's at stake?
Well, this is the long-awaited resurrection of the Doha round of trade talks, which fell apart in 2008, which trade officials have been trying to get going again, and which will hopefully be complete in 2 weeks at the meeting in Bali. What's at stake is I think, the future of the multilateral trade environment. The deal itself that's on the table, or that will potentially be on the table, is not huge. They've stripped away a lot of the more contentious topics that were frustrating talks back before the crisis, and really focused in on just a few things that they think they can get an agreement on. Things like what they call trade facilitation, which means making it easier to actually move goods physically in and out of countries, as well as a few issues related to development and agriculture. Now, the problem is agriculture is always a sticky topic, and it seems to be throwing a wrench in the works. And so time is winding down before the meetings. They had hoped to complete the agreement actually by last weekend. They're still talking, and they haven't arrived at an agreement. And so there's a question as to whether this deal will get done. And if it doesn't, I think then there will be a real concern that the WTO as a forum for these multilateral trade talks will be no more, and all the action will go elsewhere.
Now, a lot of excitement in the trade community has actually been around regional trade deals between the US and the European Union, the US and Pacific economies. Is there a sense that if even this small multilateral deal can't get done, that all the attention is going to shift towards those regional packages?
That's definitely the concern. And I think you've seen a lot of countries move toward regional deals and packages because of their frustration with the Doha round with multilateral talks. Because things bogged down there, they figured, well, we're going to go and do things our own way in order to get something accomplished. So the concern is definitely that if the WTO talks fail, that all the action will go to these regional deals. And the reason that's a problem is because rich countries are the sort of the moving force behind these regional deals. They're always going to have venues to come to new agreements. It's really the less developed countries, the poorer countries in Africa, that rely on the WTO as a forum to have their voices heard. And so they'll be the ones that are left out if everything sort of blows up here.
Is it not maybe time to put the Doha round out of its misery? It's been going on for, 12 years now. Nothing really tangible has come out of it. There's now new leadership at the WTO. Roberto Azevedo has taken over from Pascal Lamy. Is there not a sense that maybe we should just declare this one a failure and start from scratch?
Well, everyone would like to put Doha behind them and go on to sort of a new arrangement, probably where it doesn't have an official name, where there's just an ongoing series of talks and ideally agreements. I think the issue is that if you can't declare success and go on, then you don't have anything to work from, because the deal that they've got on the table at this point is really kind of bare bones. It's not that complicated. And if you can't get an agreement on that small thing, I think the feeling is that there's no point in trying to do more, trying to do other topics. All eyes will be on Bali. All eyes right now are on the countries that are hashing things out. It's really come down to India and a handful of rich countries, mainly the US, that are knocking heads over agricultural rules. But hopefully an agreement will be reached in time. But on to finance. Several years on from the crisis, we're seeing a return of some of the, I guess you might say, dodgy financial products that featured in the run-up to the financial crisis. Things like covenant-light loans. Tell us what's going on there.
Yeah, certainly in the US, you're seeing a stunning comeback of some of the more frothy types of lending that we saw really starting from the mid-2000s up to 2007, 2008. In particular, as you mentioned, covenant-light loans. Covenants are rules in lending arrangements that give power to the bankers. So if profit metrics are missed, for example, or if debt gets too high as a percentage to profits, the bankers can force you to get back to the negotiating table. Now, when the markets are good for the borrowers, they have more power to get rid of these conditions. So it's much riskier for banks, but it's much better for those who borrow lots of money, in particular private equity groups that need this leverage to juice up their returns. Now, Cov-Lite loans in the U.S. have now become the norm for private equity, which is stunning when you consider the trouble that this led us in 2007, 2008. But we're seeing other asset bubbles as well. There's a return of what are known as PIK loans, payment in kind loans, where instead of the borrower repaying cash, as you normally do for a loan, there's no cash that's repaid. It's just rolled up into future payments through equity.
So what, in your view, is driving this shift? Is it a new bullish sentiment, or is it something else? What's going on?
Well, we slightly disagree on this, but I'm seeing a lot of frothiness, not just in the credit market, but also in the stock market. We are seeing a lot of other assets that seem out of whack. It's not just London property. It's not just Bitcoin, which is I think at $600 now. We've seen art being traded at record prices. The Bacon Triptych going for $142 million. We have seen US and emerging stock markets at record highs. Snapchat, which is sort of a gimmicky app for smartphones, turned down $3 billion in cash from Facebook.
I'm sure they'll get a better offer.
It does really feel reminiscent of actually two different kinds of bubble. One of them in the late 1990s, which was the tech bubble, and the second one more recent, prior to 2008, when all sorts of assets were probably trading above their natural levels.
Well, another finance story that we covered in our print edition of the past week is a change in trends in recruiting on Wall Street. Financial firms seem to be looking for kinder, gentler employees. What do you make of that?
Yeah, so interestingly, we looked more at the graduate end of the market, but over the weekend, a new entrant to the financial services industry was Tim Geithner, the former US Treasury Secretary who joined Warburg Pincus, one of the sort of blue-blooded private equity firms in New York. Interesting because you would have thought that Tim Geithner would have the pick of joining whichever Wall Street firm he picked, and I'm a little bit curious as to why you think he might have decided to go to private equity, which is still very politically loaded following the 2012 election and Mitt Romney coming from private equity, as opposed to joining an asset manager, an investment bank, or a hedge fund.
Well, I'm sure he just wanted to find the job that would allow him to do the most good in the world. And no, I mean, I think actually probably Tim Geithner is more publicly minded than a lot of people give him credit for. I think it's not surprising that he didn't go somewhere like a Citi, which would have raised a huge uproar, or to a different firm that had more connections with the bailouts of 2008 when he was president of the New York Fed, or later when he was Treasury Secretary. I don't know, it'll be interesting to see what his involvement there is and what, if any, connection there is between Warburg and the U.S. government. But turning from Tim Geithner back to recruitment of new graduates, what do you think is behind that move? Is it just a marketing strategy, or is it about a real change of sentiment or mood on Wall Street?
So we started by looking at Goldman Sachs, who claimed they were interested in recruiting graduates who are interested in serving something greater than their personal interest. Now, this will attract a great deal of skepticism from people who are familiar with investment banking remuneration, but there is an element to it that they want to get graduates who are not just motivated by money, but also have a sense of ethics. There was a great failure of ethics in the run-up to the financial crisis and during the financial crisis, and it's perhaps not surprising that the banks want to at least be seen to be looking for a different breed of candidate.
Now, I suppose that, I mean, this really is just about altruism, or about a feeling that they weren't pleased with the way their firm was perceived after the crisis. But I wonder if there isn't some bigger angle to it, and not necessarily in a bad way, but just that Goldman actually sees some upside to hiring people that see something bigger than just the bottom line.
Yeah, and linked to that actually is Goldman and other banks are making efforts to be seen less as slave driving their graduates. So Goldman now insists that its younger workers get at least part of their weekend off. Whereas famously, if you were an associate or an analyst at an investment bank just out of university, you would really expect to be working over the weekend and a couple of late nights per week. That might be driven as much by their fears that they are getting a very particular kind of graduate who wants to come work for them. And in fact, they would be looking for a more diverse They want to be able to hunt from a more diverse pool. A lot of people who go work on Wall Street do it not necessarily to maximize their income, but also because they want to fast track their careers. And that might be that they want to continue working in investment banking, or it could be that they want to work in other fields in which they just want to use the skills that they pick up in investment banking. That may be slightly too generous towards the investment banks and their motives, but it's certainly one plausible explanation.
Well, thank you, Stanley. That's all for this week. If you have any comments or feedback, please visit our Schumpeter blog at economist.com/blogs/Schumpeter. In London, this is The Economist.